money radio for a really great future. We're talking real money.
Way back in the old days when there were just a handful of little stocks out there, you could build yourself a relatively diversified portfolio by buying one or two stocks because there just weren't many of them. But today, you need to get with the darn program, all right? Quit playing individual stocks. The world has changed, and we've discovered something really interesting. Buying a single stock is more akin to gambling than it is to investing. It's not even like building your own business because you have no control over what the stupid company does that underlies the stock. That and more is just part of the message that we recently read about in, of course, one of our favorite columnists' columns, Jason Zweig of the Wall Street Journal. Hi, everybody. Welcome to Talking Real Money. Don McDonald here in Florida. Tom Cock there in Bellevue, Washington.
Greetings. Salutations.
So what about I mean, we talked about the downside of buying individual stocks. The risk is extraordinary. But why are people still buying a lot of individual stocks? What's going on?
Yeah, this is a fascinating and I think mostly emotional situation because I talked to so many of you. I'll give you 3 in the last 2 weeks. In the last couple of weeks, I talked to a prospect who has 30% of his money in 4 companies. Right, 30%.
Four companies. Well, that's better than one.
Yeah, but I'm going on here. I talked to another who had 10% of his entire holdings in his company stock. Mm-hmm. His company stock.
Now, wait, hold on. That is really normal.
Well, we'll talk. I think it all ties into the same thing.
Okay, all right. And what's the third?
The third one was just a guy I talked to this week who said, I've listened to you guys for the last 5 years. I cleaned up my portfolio. It's fantastic.
I follow your advice to the letter.
And then I got the statements and half of the money is in 5 stocks. I thought, which part was he listening to? I mean, because it's fascinating.
The other part. That would be the other part.
The thing is, when you call people on this, and I try to be gentle because it's like, I'm not that guy who says, You're rolling your eyes. I try.
Well, you're not gentle during the show.
No, I know I'm not. But when I talk to you one-on-one, I like.
Okay, so you're afraid of being punched in the face. Is really what it comes down to.
It's
as long as there's a distance between fist and face,
it's okay.
Yeah.
And in this case, it's hard to send the punch right through the wires or however this all contraption works, which I have no idea. So, I try to gently say, "Well, tell me why. Why do you?" Everyone has a strong reason for when you hold a few stocks like this or one stock like this. I mean, Zweig asked in his article, is it a bad idea that people have been asking him to have 85% of their money in NVIDIA? Well, there's a great reason, right? Because the stock has gone up so much.
No, that's not a great reason.
That's a great reason. Look, I've been smarter than the market, right? And and then he said, somebody else asked him, should I own stocks other than Apple? It turns out here in the greater Seattle area, guess what? Most people hold the Microsoft because it's, 10 minutes down the road. A lot of people hold Costco. A lot of people used to hold Starbucks until Howard Schultz decided to lose the NBA franchise to the guys in the Midwest.
Wait. Hold on. That one threw me for a loop. Wait. People owned Starbucks until their basketball team went away?
Because Howard Schultz was the chairman of Starbucks. He owned the Supersonics. He let them depart for, isn't it like Oklahoma City or something?
Oklahoma City, and they're going to the NBA playoffs. But Tom,
people were really angry.
Is that a fact or an anecdote?
That's a fact, by the way. Here's the thing, and you can look it up. But the fact of the matter is exactly what I just said. Most of these are emotional decisions. I believe in that company for a reason. I know that company people think they know Microsoft because it's right down the street. They don't know anything more about it than if you were living in Albuquerque when Microsoft started there. Absolutely do not. But these are mostly emotional. And that's even more dangerous because I've seen it from the other side. I've mentioned this before in the podcast. I had friends that worked at Washington Mutual. And right until the end, they were hanging on a lot of money in WAMU stock because they knew someone was going to rescue them. They knew the company was great. It was the biggest trust bank in the United States. got to hold on to that stock. So
too big to fail.
Too big to fail. And of course, it didn't really, I mean, it failed and it didn't fail, right? Chase just walked in, changed the name on Monday, took over. The stock went to whatever.
Well,
went
but
to
it
zero.
failed.
It failed.
Washington Mutual shareholders lost all their money.
They did. That's correct. So you're right. In that matter, they did fail. But so most of these decisions turn out to be emotional. That's what I'm trying to get to. You're going to believe that they were made for the best of reasons, but they're not. And the people that really know this, Don, and study it are going to tell you, Warren Buffett, who's recently announced his retirement, that you should really just diversify, spread your bets across many stocks rather than focusing on a few. But there's some other great examples that Jason Zweig goes through. It's just fascinating. 10% of 300 of private foundations with more than $500 million of assets have a third of their portfolio in a single stock. Think that through a little bit.
Well, again,
huge foundations.
They're no different than the rest of. In fact, they're probably more confident than the rest of us because they're actually getting paid under the perception of brilliance.
Yeah, exactly. They have people, as it were, that are telling him. He goes through some great examples, by the way, of people that have told him about stocks they own. I don't know VF Corporation, which apparently makes clothing and footwear. It through 10 years ending in December 2019, it had an annualized return of about 22%. 22% a year, far better than the S&P 500's 13%, right? So one foundation went out and bought basically their entire foundation in VF shares, $3.3 billion. And the stock lost 78% in 2023. I mean, so these examples are over and over again, but you cannot convince people. Bigger than that is Professor Bessembinder, who we've talked about before, who looked at returns.
We love Professor Bessembinder.
He looked at the 28,000 stocks whose returns can be tracked between 1926 and 2022, almost 100 years, and about 60% of those made less than U.S. T-bills over their full history. So why would you try to pick the ones that are going to be better? And this is the challenge I have, is trying to convince people of that.
And for your edification and the edification of others, because I'm sure many people are going, okay, you're right. I don't know what VF footwear is. Well, actually, you do know.
I'm probably wearing it right now.
Yeah, it's very likely
Okay.
Somebody out here is wearing it right now because VF footwear is one of these companies that's acquired a lot of very well-known brands like young men's favorite, Vans, V-A-N-S,
yeah, of course.
Vans.
Sure, yep.
A lot of folks in the Washington area's favorite, not in Florida, the North Face.
Yeah. Yep,
Timberland.
Big. Mm-hmm. Yeah, so you're right.
Big Midwestern favorite, Dickies.
But it also shows you how one company can have a superlative performance for a period of time. And that same Microsoft is right down the road, up. And then for an entire decade, it basically made nothing. So this foundation poured all that money, $3 billion into VF, only see it to go down by almost 80% in 1 year.
Any company can do it at any time. And this is just like our argument about the stock market, trying to time the market. Nobody rings a bell or sets off a siren or an alarm saying our stock is about to go down. Your problem as an investor is the fact that you believe that you will know something that can't be known, and that is the future. They don't tell you in advance. And by the way, if anybody's going to know in advance, it's going to be people who work at the company.
And they probably shouldn't be using that information. And there's a couple of risks, right? There is this risk of underperformance or vast underperformance. That's a risk, a big risk. And Bessembinder points out that most of these stocks have made less than treasuries. That's one. But the other is far more dangerous and really fatal when it comes to your future, your financial future. That is default, because the aforementioned Washington Mutual went to zero, Enron zero. There's all kinds of companies that went to zero. And if you have a ton of money in those, boy, that can really hurt your overall financial situation. And if at the beginning of all this, you realize that those individual companies are just, you don't know what's going to happen to them, you'd rather buy the market. Why would you have money in those stocks one at a time, knowing that ahead of time?
Yeah, I once created a presentation that we used for a little while years ago about a portfolio where you said, I'm not just going to own one stock. I'm going to own what are currently being written about as the best stocks in the country. And I'm going to build myself a portfolio. I think it was of 4 stocks, if I remember correctly. And let's see, the 4 stock, and this is off the top of my head. The 4 stocks I believe were the best new energy company in America.
Was that Enron?
Enron.
Okay.
The best run airline in America.
That wasn't Eastern Airlines, was
Delta.
it? Delta. Okay.
They're still here, but they went bankrupt and shareholders lost everything.
Yep.
The biggest telecommunications firm in the country.
Is that AOL?
MCI WorldCom.
Okay, MCI WorldCom.
Bang, gone. And what was the 4th one? There was a 4th one.
But I do remember the presentation.
You put your money into this portfolio of 4 of the best stocks at the time.
Yep.
And you lost every penny.
It's pretty shocking. Really is. So again, back to where we started. These tend to be emotional. And so when you hang on to things like that, that can really be hard on your portfolio. But when people bring these up, and I try not to argue with you about the company because I never win.
Oh, no, you can't argue about the company. Because it's an emotional thing.
That's what I'm saying.
It's like arguing politics, and we know from experience on this program that even the little tiny bit we
barely
talk politically, that we get slammed.
Yep.
By both sides.
Absolutely.
You get notes from your lib friends, and we get notes from our Trump friends, and it's like, wow,
et cetera.
Guys.
Yeah, never the twain
Lighten
shall
up.
meet. Yeah.
America, remember America? But anyway,
it's
emotional. We get so emotional. We get so attached. We tell ourselves a story, and we're not going to let anybody sway that story that is so embedded in our little pea brains.
Yeah, and if you're going to own individual stocks, why? That's what I always ask. Well, the number one reason
to make more money.
Yeah, I want to outperform the market. Mm-hmm. I know this company, and it's going to make more than just being diversified. Number 2, generally people tell me, well, I know something about this firm, the firm's future that other people don't know.
No, you don't.
No, you don't. There are hundreds of millions of dollars being spent every year on large publicly traded companies to evaluate them, to see what's going on in the inside. They spend a lot of money, which you don't have.
Unless you're the CEO/CFO, you don't know more.
And you occasionally read those stories, but less.
Yeah, but if you're remember Ken Lay from Enron?
Yeah, of course.
Oh, I didn't know we were in trouble. They kept it from me.
Fast. Yeah, that was Skilling and all those guys down the hall. And here's the final one that people do tell me. They do tell me this, and it makes me think, wow, good for you. It's money I can afford to lose. Now, if you can afford to lose 40% of your portfolio, you got to have a big portfolio. By the way, there's an aspect of emotion to that, too, because I don't care how much money you have. If you lose 40% of it, that is going to be a painful experience no matter the size of your portfolio.
Exactly. There's the point there. You're lying to yourself. If you believe there's a large chunk of your wealth that you can literally afford to lose and will not be upset about losing it, you are a liar. Because even compulsive gamblers hate losing.
Yeah. And it's painful, as you said.
And they lose more than they win, and they still hate it. It's just the compulsion overwhelms the negative feelings.
No. So please,
don't.
You can call me. You can send me the statements, but you know what I'm going to say. Clean it up. And by the way, there was somebody else we met about 2 months ago that did. It was in his qualified accounts, and he went out and sold those stocks, realized that's not a good way to operate.
And let me tell you, you can't. You can lie to yourself all you want, but you are lying to yourself when you say, oh, I'm following Tom and Don's advice and I have a diversified portfolio, and then you have any portion of your portfolio, like over 1%, that's in an individual stock. You're not following our advice. Neither of us would own 1% of a publicly traded stock. Now, that is different than owning your own business. We want to differentiate because this is an important differentiator, and it's sort of the same differentiator between a stock picker and Warren Buffett. Many of us have a sizable portion of our wealth tied up in a small business that we may own a part of. That's a different thing. That's not betting. That's putting your money where your work
risk,
is.
But it's a different type
high
of risk. Yep.
But it's a different feeling of risk, and it's one of those necessary risks for many entrepreneurs or small business owners. You got to have some of your money tied up in the company, because where else are you going to get it?
Yeah,
it's
exactly.
Come from you.
Exactly.
Yeah.
So that's a good point. By the way, those of you who think you're above average stock pickers, I think I've seen you on the road. You think you're above average drivers, and you're not. There's other parts of your life you might think you're above average, and you're not.
And by the way,
even
though Tom claims he's really nice to people who are fooling themselves about stock, those who are fooling themselves about being above average drivers, he shows no mercy to.
No, I stay 2 lanes away. That's
you need a recording of Tom driving 405.
I had to do it yesterday. It was painful.
Or my favorite is merging from 520 onto 5 to get off at Mercer.
Oh man, the Mercer dive. That's the worst.
The Mercer dive.
Yeah. All right.
Okay, I got to go across 13 lanes.
I know, 4 lanes in about 30 seconds. All right, question time. And by the way, we're running a little light on the typed questions. So if you could get in there.
Tom needs some questions. Go to talkingrealmoney.com. Type a question. He loves his paper.
I do.
But in the Pacific Northwest, they have plenty of trees. He can kill a few.
I got enough trees in my yard to take care of my paper needs for decades.
Not as many as you had in your old yard.
Yeah, that's true. All right. Steve writes us from Edmonds, Washington. I own a business, and I'm purchasing an asset for $550,000 that will generate a return of 40% annually for many years.
Mm-hmm.
I'm going to say congratulations.
Yeah, that's
really good. I can get a bank loan to buy it, pay cash from the business, or loan the business the money at 6 to 7%. Which would you recommend?
The business has cash? I heard that part.
I can get a bank loan to buy it, pay cash from the business, or loan the business the money at 6 or 7%. Which would you recommend?
If the business is not cash strapped, then I would use the cash from the business. And then if the business needs cash later and you can't replace it with that high yielding investment that you're getting into, you could borrow then.
Because the bank loan, even if your credit is really good in a commercial loan situation, might be like 10.
Yeah.
I'm just guessing. I don't know.
For a small business, because major corps are paying 5 and 6.
Yeah. So, you're probably looking at twice that. He also adds, I don't need the money to live on. Seems I can get a guaranteed rate of return on cash I have, which is currently in a high-yield savings account, 74 years old, and collecting Social Security in a military retirement. I mean,
I'd go with the cash, because the smallest cost of cash is the cash, because you're gonna lose the return. But see, with the other situation, you're going to pay a higher yield to borrow. The company's going to pay a higher return. I guess you could lend it.
That was my 6 or 7.
My first choice, though, would be taking it from the company.
Absolutely, 110%. I mean, that's because I think with any firm, there's a risk to borrowing money, right? Because something goes wrong, you got to pay it back. No offense, but at 74, there's an age risk here at some point. Not that 74 is old. I can't call you old, but something goes wrong.
Yeah, I'd use the cash. No, I'm not. I'm just really struggling to find a benefit. I know large corporations can find some benefits in borrowing,
tax reasons,
tax reasons, and others, liquidity, because they need it. They want it for dividends, or they want it for some other more valuable purchase. But the reality is, but they're not going to pay as much money to borrow as you are. You're going to pay dramatically more than they are, which is why I think small companies should avoid borrowing unless it's necessary. Now, of course, it's often necessary.
Yep. Okay. Thank you, Steve, for the question, and good luck. Wow, 40% annualized return. How can you say that moving forward?
I can't. I don't think anybody can.
I don't know anything.
I think you can say it has been doing that, but whatever it is, whatever the gadget or the gizmo or the property is, there's always the risk that whatever's working now will stop working due to some upheaval.
Can you remember, most of us probably like the spring of 2020? I mean, things that looked like no-brainers for the next 50 years blew up in a month. Anyway.
Yeah, it happens.
And by the way, I don't think the restaurant industry is still recovered from that.
Oh, heck no.
Because places I go still don't do lunch anymore. Like, well, remember we used to go there for lunch? Nope, only do dinner now because we don't have anyway, it's a whole
Well, because staff's one of the reasons.
But that was kind of the beginning of this whole change.
The other reason is that people got in new habits. Their habits changed.
Exactly. Yeah.
We change very quickly.
Yeah.
And it turns out that animals actually evolve a lot more quickly, too, than we thought. It was funny. I heard a piece on NPR the other day about hummingbirds in California. And this young woman studied the preserved bodies of hummingbirds going back 100 years.
Really?
And discovered that with the advent of backyard hummingbird feeders in the past 60 or 70 years, hummingbirds evolved longer, thinner beaks so that they could get more out of the more nutrition out of the feeders, and their range increased dramatically. So they bred more because they had more food, and as they did that, their beaks increased. They evolved in a human time span. You can actually see the evolution happen. It's really fascinating.
On that note,
yes.
You like that? On that note, hummingbird. Well, let's go to another question.
They don't sing. The hummingbird.
Okay.
The humming is their wings
letting it go.
They don't sing.
Letting it go.
No, but there's no note. Okay, so it's not a good joke unless it actually is applicable.
When was the last time I told you a good joke?
There was one a couple of months ago. I laughed.
I got to remember. All right. Kristen writes this from Macomb, Illinois. Don't know the place. I'm about to finish up another undergraduate certificate. Fantastic. And will be likely pursuing opportunities using that certificate following licensing examinations. Well, that is awesome. My current employer takes 3% of my pay and puts it in a 401k. So my question is this. My 401k is with Mutual of America.
Ew.
Sounds like an insurance company. I already have a Roth IRA with Fidelity. Is it okay to take the taxes off the money and roll that into the Roth, or should I leave it in the Mutual's account because it probably won't grow after I leave current employer to pursue opportunities? In other words, leave the money behind in the old plan, Mutual of America, or pay the tax, roll it from the traditional 401k, I believe is what you're trying to say, Kristen, to the Roth IRA at Fidelity. Well, part of it depends on a couple things, how much it is, and then if you have the money to pay the tax, because you're going to pay tax on that move, right? That's simply income to you. Maybe your income's low too because you're in school. I don't know.
Well, but my first problem is where this money is held and what investments it is.
Well, that's always the important thing.
I think that the investments, my guess is, and I haven't done any research on them whatsoever, except to know that they are an insurance company. So I'm going to make an assumption, since they also sell annuities, that their 401ks probably, many of them, probably include annuity products, which are one of the dumbest things you can put in a tax-advantaged vehicle like a 401, 403, or an IRA.
Yeah.
So I would be sorely tempted to, if you have the opportunity to make a transfer, rollover, you do that.
Yeah. Clean it up, too. Don't leave it behind.
It simplifies and probably gets you better investment vehicles.
Yeah, I think that's good. By the way, I want to thank Michael for sending in the following joke. You actually sent it in.
No, you're getting jokes now?
Yeah, I actually got it. And this is a good one. I think this is really good.
Right.
I think this is really good. You know why you can't hear a pterodactyl go to the bathroom?
Because they don't exist?
Because the P is silent.
Because they don't exist?
The P is silent. Are you tired of those hosts laughing at their own jokes?
Can I just tell you, that joke,
it's hilarious.
That would be one of the jokes a fourth or fifth grader would pull out the joke book.
That's about my level. I'm good with the fourth or fifth graders.
I mean, really, remember, did you see The Last of Us?
I'm not watching this. I watched the first part of this.
Well, no, last year.
Depressing.
Last year.
Yeah, I watched the previous one. Yeah,
she had a joke book and she told stupid jokes.
Yes, I know. I love those. I have a list of those I'm going to use. I haven't got to them yet. So, no, I haven't watched this season. It's too dark.
You're still 10.
This is just coming to you now?
You're still 10 years old.
I was hoping for 12 by the end of the year. But
no, you're not going to hit 12. You'd be lucky to get to 11. You're still going to be prepubescent in many, many respects.
All right. Well, I'm okay with that because then I'm a child at heart.
I will give you that.
Okay. All right. No more wrestling over
Are we done?
stuff. I'm done.
Do you have
please send your
anything else you'd like
questions
to
in.
add?
Please ask for help if you need it, because we do review everything and we do it free.
Go to
no obligation.
talkingrealmoney.com.
That's pardon me. Yes, thank you.
Click on the Meet an Advisor button.
Yeah, that's all you
Also, go to talkingrealmoney.com and ask more questions.
Yeah, we need more questions.
We need more questions.
Yeah.
Go to the contact form. You can also call us on Saturdays. Every Saturday, one of us is here.
I'm going to be here for a while.
No,
a while.
Usually, for the rest of the summer, it'll be usually me.
But now that Don gave me a microphone that's, the size of a tin cup, a tiny little thing. And I'm going to, wherever I am, I guess I'll be on the show. So
you're not going to be doing the show, just the podcast.
I can't do the show, but I can do the podcast.
You can do the podcast.
Wherever.
Yeah. You got to be fancy to do the show. That's
true.
Radio.
That's a different deal.
You got to have a tie line.
Tin can is right. Yeah.
Tie line. All right, I got to go fix some stuff. I'm having a funny noise in my headphones, so I got to go fix
it's just
my
not
audio.
In your head. That's it.
Could be in my head.
All right.
That's why I got to check. It's called troubleshooting.
Fix.
First, I'll turn off my brain and see if it stops.
Please don't.
Thanks for being a part of Talking Real Money. I'm Don. That's Tom. And, the name of the program is What We Do. And what's the name of the program?
Talking Real Money. Yeah, that's it.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.